Hello and a very warm welcome to the first of several planned Symbiotics webinars to inform you about the activities that we conduct and of some of the research pieces we provide. This webinar is based on a piece that I wrote together with Roland Dominicé at the end of last year and at the beginning of this year, called Perspectives 2050, the role of microfinance in bridging the capital in the north and the needs in the south. My name is Christoffer Dahlberg. I head up the investor relations team based in our Zurich office that I started 2.5 years ago. The idea with this paper, which took the form of a white paper that we have since distributed to clients and prospects, was really to put the asset class which is ours in a global context, and to base that macro analysis firstly on some of the so-called asymmetries we see in the world, and then also take a portfolio perspective and see how it can help in remedying some of those problems. So here we go. Let me start by showing you some numbers that some of you will absolutely recognize, but that are still significant to illustrate the size of the challenge we face. So 4 million is the number of jobs that we believe the investments of Symbiotics and by Symbiotics through the years for our clients have contributed to. That's obviously 4 million jobs in some of the countries of the world that need them the most. 4 million people and their families having a better quality of life. You could also say 4 million people who don't need to work in a textile fabric in Bangladesh or elsewhere to support their living. 24 million, well, that is the number of micro, small and medium enterprises across the emerging world that it is estimated that the world of microfinance, in other words, us together with our competitors, have contributed to since the start of the industry, if you put the start around 20 years ago. But in spite of that, the enormous number of $2,500 billion, well, that is the estimation of the so-called missing middle. In other words, the missing capital to finance the development of small and medium enterprises in developing countries. These SMEs that in every developed country make up more than 95% of all companies, typically employ 2/3 of the working population, and contribute around half of any developed country's GDP. So that's obviously why we do the work we do, and why we continue to do that work since now 13 years. In other words, assisting the money from the north in finding investment needs in the south. For most of the people listening to this webinar, our activity will obviously be familiar, so I won't go into details of that. But we know that we have invested something like $3.5 billion across the emerging world, something like 75 countries since 2005, and we currently manage about $1.5 billion in the form of advisory and management mandates. We also know that our work represents a lot of work, a lot of traveling. I don't need to detail that to you either, but I'll say when you look at this map that what we usually tell investors is that in the markets we're active in, there is no Bloomberg. There is no external research database to go to have an easy access to information. The work we collect, the work our analysts collect is manual work, and it's really based on the quality of the input we get is based on what they are able to collect. The other thing that is worth pointing out is that when you look at this map, it becomes clear that we bring the parts of the world to an investor's portfolio that typically are not represented. In other words, if you take the investment portfolio of an investor in the developed world, there is very little Africa, there's very little Asia, there's also very little South America. So we bring markets that would otherwise not be in portfolios, and by doing that, we bring diversification, and obviously we also bring social return. So the agenda for this webinar will be as follows. We will have a quick look at the evolution of the microfinance industry during the last 2 decades. And I will then talk about what we've chosen to call the 4 global capital asymmetries. In other words, 4 of the big major global economic problems that we see today. And after that, in order not to focus just on the problems, we will talk about investment solutions from the perspective of what our asset class can bring to a diversified investment portfolio. And we'll finalize that with a summary. Now, when this presentation was done in form of a knowledge sharing in our Geneva office, some questions came up, and I will try to integrate those questions into the webinar as I go along. So we've chosen to speak of microfinance in a 20-year perspective, and we do that because the first microfinance funds were launched precisely 20 years ago. But these funds stayed small, basically for 10 years. And the important evolution and growth of the industry has really happened during the last 10 years. And there it is really, we really talk about a steady trend. A few months ago, meaning late 2016, we published the 10th edition of the so-called MIV Survey, the annual report, originally mandated by the World Bank, that we produced since 10 years. At the time, it was CGAP, the microfinance organ of the World Bank, that chose Symbiotics for the compilation of this report based on the quality and the depth of our research. And obviously that research has developed many times in the last decade. So today, this is by far the most complete report on the industry of microfinance funds, and it covers around 95% of all funds around the globe active in this field. So just to show you some illustrations from that report, if we start on the left-hand side, you'll see again now in graphical form the number of 24 million I mentioned. In other words, the number of micro, small and medium enterprises estimated to be supported financially by the microfinance industry. A number that, in other words, 10 years ago was very close to 0. A number you will not see on this chart is the current size of the microfinance industry, which is estimated at around $12 billion, and which again was about 0 around 10 years ago. In the middle, you see that it is not an industry that is exclusively focusing on women, but there is still a majority of women being financed by the microfinance industry. And the fact that this ratio is stable at around 70% is actually quite an achievement when you take into account the challenges women face in many of the countries we're active in terms of getting an education, getting a job. And then finally, what you see on your right is that in spite of the very strong growth and the strong development that the microfinance industry has seen, the average credit to the end client has remained extremely stable at around $1,500. And that shows that in spite of the growth, the industry has not lost its focus. In other words, the industry is still focusing on financing the bottom of the pyramid. So what about the financial performance of our asset class, given that, after all, it is a for-profit industry that is supposed to bring both financial and social performance? Well, as you can see on your left, there has certainly been a certain deterioration in terms of financial return across the last 10 years, and thereby the performance of the fund has diminished slightly. But as you know, that reduction is very far from the deterioration that we have seen in traditional markets in terms of interest rates and money market rates. And that means, as you see on your right, that the spread of microfinance to traditional cash investments has gone from being negative 10 years ago. In other words, you, so to say, lost money by investing in microfinance versus having your money in a bank account, to being largely positive today. In other words, if you earn 3 to 4% net on your microfinance portfolio, that is about 3 to 4% more than you would on a cash account, given in most developed countries, interest rates are currently at zero or even negative, or otherwise very low. And that is obviously a factor that also contributes to the popularity of our asset class among certain investors. It is clearly a different situation if you're managing a big investment portfolio, if you can earn 3% on your cash, or if you earn nothing on your cash. If you can earn 4 or 5% on your bonds, or if you earn close to nothing on your bonds. That poses a number of challenges for investors, and the 10 years of track record we have in terms of delivering very solid financial returns have certainly made a lot of them look closer to our asset class than they would have otherwise. So if the industry of microfinance has seen this very strong growth over the last decade, and also a great stability in terms of both financial and social return, that is not necessarily the case for other asset classes. And to that come certain macroeconomic factors that will have a very large influence on investment portfolios going forward, and that we have chosen here to summarize under what we have called the 4 global capital asymmetries. And I will go through these one by one. The first is probably the most important, because it is the one that has a lot of repercussions on other factors, and that is the asymmetry of demographic growth. Many of you will have seen this graph and will be familiar with it, but what we note is that it is something that is not very openly discussed, and therefore I think it is important to bring it out and to repeat it and to repeat the message. And the message is obviously that we are today at the green line with a world population of about 7.5 billion people. And we know with quasi-certainty, and quasi-certainty means unless we get hit by a meteorite, or unless Kim Jong-un blows Asia up through a nuclear war, we know with quasi-certainty that the world will be at 10 billion people in the year 2050, in other words, in 30 years from now. So 2.5 billion people more walking the face of the earth in 30 years. That means a net growth of 200,000 people per day, every day, between now and 2050. As the colored lines show you, this development does not happen in the developed world. There's no population growth in Europe, there's no population growth in America. The growth really happens in Africa, in Asia, and it mostly happens in poor countries, in poor families. So what happens after 2050? Well, that's a bit more uncertain today, but it is probable, as per what we know today, it is probable that there is a continued growth of population, meaning that by the year 2100, 90% of the world population would be living in Africa or in Asia. In parallel to that demographic growth, there's also a structural change happening in developed markets. It is a fact that we're getting older and that we're not having enough children, meaning that the number of retired people that every working person has to support will increase, and it will increase greatly. In Europe, this so-called dependency ratio will go from 30% today to roughly 50% in 2050. In Germany, the engine of Europe, the evolution is even worse, and the ratio moves to something like 60% by 2050. In the US, it's slightly better, but in Japan, Japan being the 3rd largest economy in the world, it is a catastrophe from a demographic standpoint. The current Japanese population is of about 125 million people, and that population will diminish to between 90 and 95 million people in 2050. So a reduction of something like 30 million people in the coming 30 years. So the question that is sometimes asked is if immigration from the developing world to the developed world can help stop this deterioration of ratios. And the answer is that of course it can, but it would be a great challenge. And to give you just an idea of the numbers, we know that if you look at Europe alone, in order for immigration to keep the ratio at where it is today, roughly 30%, it would mean an immigration of about 100 million people to Europe from now until 2050. And that's 100 million people in working population, active working population. It is not their families, it is not their relatives, it is just working people. So it becomes clear pretty quickly that immigration can certainly help alleviate some of these aging concerns, but it will not be a remedy to the full situation, and it will obviously also not solve the issue of the emerging markets themselves if people with working skills move away. If you look at these factors in color, it becomes somehow even more obvious. So currently it is the green parts of the map, the upper map, that have a young population. And what you have to add here is really to say that, you know, a young population is not the only factor that decides of a country's economic growth or of the success of a market. But history teaches us that it's a very good start. And given it is a very good start, it is certainly from an investor point of view not wrong to look at this map as basically thinking of the green and yellow parts as a buy signal and the red to deep red parts as more of a sell signal. If you don't take this demographic evolution into account in your investment decisions, well, we strongly believe that you are really missing the next global wave of investments. The second asymmetry is that of economic growth. And as mentioned, you know, demographic growth is a good start, and that's really what the statistics show. Here we illustrate the growth projections between now and 2021, and if you look at the list on the right-hand side, what is really striking is the fact that not a single of these 20 markets that are listed and that are the 20 countries that are expected to see the strongest growth until 2021, not a single one of them is in the developed world. They are all in the developing world. And equally, it's fair to say that with one or two exceptions, you will not find a single one of them in a typical investor portfolio in the North. Whereas if you look at our investment portfolios, again, with one or two exceptions, we are present in all these countries. So we come back to the argument from the start. You know, we bring diversification to investor portfolios, and gladly or luckily, that diversification comes through countries with very high growth numbers. The third asymmetry is that of credit markets, and we'll look at that from a couple of perspectives. It's sad to see, but it's maybe not a surprise. If you have a bottom line consisting of aging populations and low economic growth, it is not a surprise that the indebtedness level of the developed world that you see in blue on the right-hand side has continued to rise. If you have an environment as the one we have today with extremely low interest rates, around zero, that level of indebtedness can be carried, is sustainable for the time being, but obviously it puts a brake on potential economic growth. The other factor is that a lot of this debt does not go to finance new initiatives, to finance small companies needing financing. No, a lot of this debt actually goes to financing old consumption behaviors. And in other words, it's not used very productively. And if you combine this with the fact that if you're an SME in Europe, you know that financing through banks has been become much more difficult to come by today than 10 years ago, then that obviously also points to slower economic growth, because if companies cannot obtain financing, well, then they're not going to grow. On the right-hand side, you also see that the indebtedness of emerging markets hasn't really changed over the last 10 years. It stayed relatively stable at between 100 and 150%. Now, it's always been said in economic theory that emerging markets cannot support the same level as indebtedness as developed markets can because their economies are not as developed. And that's certainly true. But we are today at a situation where the developed markets' indebtedness is about 3 times that of emerging markets. So the question today is probably more whether developed markets can really sustain this level of debt. So if you come back to the map we showed you previously, if you look at the penetration of financial services, well then the colors have really been reversed. What you see now is that in bright colors, in bright green, you have the countries with a strong penetration of financial services, and in darker green, you have the parts where penetration is far less. And nowhere this penetration is lower than in Africa, where we know that today about 60% of adults have never been in a bank, have never had a savings account, have never held a bank card in their hand. So, according to economic theory, some of you will be familiar with the theory talking about the invisible hand by Adam Smith. This invisible hand that is supposed to redirect money from saturated part of the world to opportunities in other parts of the world that have too little money. Well, it seems pretty obvious that this invisible hand is not acting on a global scale at present. So let's remind ourselves that as you look at these dark parts on the map, these are again the countries that will still see the strongest economic growth over the coming years. So you can't help but ask yourself the question, what if we had had financial services in place in these countries? What could these growth numbers have been then? That is obviously not the case, but it shows a bit how critical it is to really develop financial services in these parts of the world. It's true also to say that microfinance has done a great contribution to improving this situation in terms of bringing financial services to parts of the world where they were previously not present. But we know that the needs are still big, and we also know that the needs will continue to develop with the demographic growth. So the last and fourth asymmetry is that of interest rates. Everyone knows the graphic. We all know that in our part of the world, interest rates are around 0. And let's remind ourselves that why are interest rates at 0 today? Well, the logic was after the financial crisis in 2008, 2009, the logic by central banks for lowering the rates was to say that lower rates would support the economic recovery. Now, it is debatable whether that has really been the case, but it is a fact that the economic recovery that we've seen after the financial crisis is the lowest seen since the Depression in the 30s. And let's also not forget that the recovery, which has been weak but is still a recovery, has now been going on for the latest 8-9 years. And we know that there will at some point be a correction. And in fact, if we were to reach the year 2020 without having seen a contraction or a recession in the economy, it will be the first period of 10 years that has not seen that in the last 120 years. So again, we're not here to share our ideas about world markets, but it's clear that the obvious question, as always, is this time really different? Well, probably not. You will probably see a correction in developed markets pretty soon. And then the problem is obviously that you will be in markets where rates are already at 0, so you can't really lower them. So you can't really support the recovery next time around with financial policy. So, there are alternatives. And interest rates show it well. There are alternatives to continue to invest in saturated markets. And those alternatives are obviously based around investing where investments are typically not made, where credit markets still function, and where thereby the risk of investment is paid for. And that is also the markets where the capital needs are the largest. So if we switch and talk about these investment solutions, to give you a few more perspectives on what we call impact investing. So a few years ago, I was working in the traditional financial world. I was managing a fund of hedge funds at the time, and I was permanently on the lookout for, investments that would really be decorrelated to other asset classes, and that would thereby bring diversification to investment portfolios. So the general view of emerging market investments is that they are risky and they are volatile. And that is true, but it's true for listed instruments. It's true for listed equities and for listed bonds. And we also know that it's partly true because of events that happen in the investors' home markets, not in the markets in which they are invested. But given their instruments are listed, as soon as something happens in their home market, they will sell and they will repatriate the money. And that creates a lot of volatility also in emerging markets. And that's why, in our view, private equity and private debt have a decisive advantage in these markets, because by definition, money can't just be sent home as soon as you're scared. And that's obviously also valid for microfinance. So the first rule of making money is not to lose money. And the second rule is really not to forget the first rule. And what that means is if you control your downside, you don't need to be spectacular on the upside, because you will anyway end up pretty high up there. And that's precisely what the asset class of microfinance shows. It is the green, very stable line that you see in the middle of the graph. And it's obviously especially visible in the period 2008-2009, where you saw a very strong correction in all other asset classes, basically equities, bonds, but also hedge funds, commodities, and other types of investments. And that means that if you have an asset class with these characteristics and you bring that into a traditional investment portfolio, well, it's not going to move with other asset classes. And that's really what the correlation numbers that you see here illustrate. This asset class has no correlation to basically anything but cash. And that means it brings diversification. And what you can do then is what you call optimizations. In other words, you can take a portfolio, a real portfolio or a theoretical portfolio, and you can then start to add microfinance into that portfolio. And you can show this in many ways. But the message is really this: if you do that exercise, because of the great stability of the asset class, typically the risk-adjusted return of that portfolio will improve. So you will get more return for the same amount of risk taken, or you will even get more return for a lower amount of risk taken. And the great thing is really that you get this truly great financial performance, but it's not at the cost of social performance. It is really together with the social performance. The 2.5–3 billion people that will come to the world between now and 2050, they will be born in the darker part of the map. And they will have the same needs, the same legitimate needs than we do. But at the current status of things, they will have very little possibility of realizing them. But what they will have, as we know today, already in 3–4 years, is they will have connectivity. It is estimated that 90% of the world's population by 2020 will have internet connectivity that is similar in speed to what we have in Europe today. Now, whoever says connectivity obviously says visibility, and that visibility goes both ways. It's going to be very clear for the young population in emerging countries what we have in the Western world, what these legitimate needs and claims are. And it will also be very visible for our children or anyone in the developed world to see what the real situation is really like in the developing world. And obviously there's a technical evolution happening. We're just at the beginning of a digital revolution that will take the world in directions we don't know yet. And it's very probable that this whole development will be influenced by that as well. And so that's an evolution that we don't know. But it's difficult to imagine that whatever that evolution is, it will be possible without good governance, without functioning infrastructure, digital or physical, without social protection, and ultimately without financial services. So as we near the end, I come back to the beginning of the presentation, which is really the whole of $2,500 billion, or if you prefer, $2.5 trillion in financing needs of SMEs in developing markets. If we want to see the global development that we all wish for, well, this is really the hole we need to fill. So as you see on the left-hand side of the chart, microfinance has provided a great contribution to financing the micro part of the equation. But as we also know, micro companies stay in the informal economy. The multiplying effects that are so precious, that come with jobs, with salaries, well, they come in the SME sector, in the official economy. In the countries that see this hole in financing, you have on one hand a large part of the population that is poor, that does not have a regular salary above $2 a day. And then on the other side, well, you typically have large multinationals, large multinational companies, and you have wealth that is really concentrated among a few people. And in the middle, there's a hole. So this pyramid in terms of income, well, that pyramid is very much steeper than it is in the developed world. So these two extremes of having nothing or having it all are further away from each other. And, as history shows, it is extremely important that we bring them together, because it is really in the middle of that pyramid that the economic resilience develops, because of innovation, because of entrepreneurship, because of multiplying effects that are created as jobs are created. So this is really the tissue that brings the two sides together, and that is why it is so critical that we fill this financing hole. And in fact, financial services, will they go further than just the pleasure of having a bank account or an insurance? If you look at the 17 SDGs that were defined in 2015, you'll see that 13, as per our estimations, are directly linked to financial services, and the other 4 benefit from it in an indirect way. Good health, good education, clean energy, clean water, eradication of poverty. Well, that is not something that happens without finance, without financial services. So in summary, let me resume in a few points what we believe is essential and critical. Firstly, most emerging markets have a young and strongly growing population. We know it's not the only factor, but we know from history that it is actually 2 very strong factors that support economic growth. Secondly, these problems that we have in the Western world of over-indebtedness and demography, they're not going to go away. They're just going to get worse, And that means that the most probable scenario for developed economies going forward is really a sustained period of slow growth at best, in some cases of negative growth, which obviously limits your investment possibilities greatly. Thirdly, we live in a populist era, but there's no quick fix, there's no populist remedy that can rebalance this demographic growth we see in the South with the saturated markets of the North in any quick way. The financing needs are just too great, and the imbalance in terms of demography is just too great. So we need far more ambitious policies in the form of joint development and partnerships between public and private to have any chance of filling these demands. Fourthly, the economic potential of emerging markets is just enormous. If you talk about 2.5 people being born into markets, that translates into a lot of growth possibilities. So it is really as much in our interest as in theirs that we put the northern capital, the capital from saturated markets, at the disposal of the southern population and also the investment possibilities in the south. That is really in the true sense of the world, it is really a win-win. And finally, you know, if I may end a bit philosophically, I think the negative populism that we see in a lot of countries today is really based on being scared of the other. And that kind of populism can only be beaten if you help the understanding of the other. And if you show that, you know, white, black, or yellow, whatever religion you may have, we all work in a similar way. And I think that proof has been brought by our industry in the last 20 years. That proof is brought every time when a group of women in India pay back their credits with lesser defaults than the clients of American Express. Or when a small leasing company somewhere in Africa shows growth numbers that are higher than SMEs in Europe. And that understanding and you know, belief in the other, that is something that this industry, through our clients, help now, in the case of Symbiotics, since 13 years. And I'm quite sure that we will continue to do that work and to bring that understanding in the coming decades, and that we will see an increasing number of investors that join us on that journey. Thank you very much for your attention, and if you have questions on this presentation, you're very welcome to pass them on to me at any time. Thank you.